Good evening, everybody. Greg McDermott with Cyber Trading University, welcoming you to our free FX webinar, Trade FX on Your Schedule. Again, my name is Greg McDermott with the FX department at Cyber Trading University. I'd like to apologize as we get going. I am in the midst of battling a sinus infection that is going to hopefully not turn into bronchitis. So I realize I'm sounding a little scratchy, and if you catch a pause, that is probably me grabbing the mute button and trying to prevent me from coughing in your ear. So I apologize up front for what might be a little bit of an audio challenged class this evening. So let's get started. Here's the CTU risk disclaimer. Take a moment for everybody to take a chance to read that. Next, about Cyber Trading University. CTU has been an educational trading institution since 1995. Cyber Trading University established itself as a leader first by working directly with the SOE's trading firms to teach them to day trade. CTU was one of the first to establish itself as a quality stock market trading school. Each instructor, including myself, has a minimum of 6 years of actual trading experience before they begin to work with students. Over the past 14 years, we've taught thousands of students to be successful and profitable traders. The CTU headquarters are located in the heart of the trading world in New York. As I always say, this is my mother's favorite slide. That's me. Earned my master's degree of applied finance from Macquarie University in Sydney, Australia in '89. Bachelor of Science of Financial Management from St. Joseph's University in '87. Crude oil options trader at the New York Mercantile Exchange, head options market maker for JAS Securities at the Philadelphia Stock Exchange. While there, I managed the firm's portfolio risk for our team of 10 options floor traders. I was also at that time a market maker in the Dell computer crowd on the floor at the PhilX, which at the time was the busiest equity option traded in the country. I directed our all-floor trading unit for JAS that we had, and a qualified, while I was directing that off-floor unit, qualified for the as a DTR for the International Securities Exchange, the ICE, the ISE. Why should you trade Forex? I'm sure that's the question you asked yourself when you joined us this evening. Maybe you're interested in Forex, you've heard about it, you're not sure, and then figured, hey, let's see what CTU has to offer. Well, there's a couple of really good reasons, and I'm going to just say one more time, you may hear me go quiet a couple of times as I hit the mute button because I am kind of coughing, so I just would like to apologize again for that up front. Why? Well, first, it's the largest financial market in the world. The volume traded daily by in the currency markets around the world dwarfs any of the listed stock exchanges traded here in the U.S. or abroad. Easy to profit in up and down markets. I really believe this is one of the true advantages of trading the currency market. If most of you come to us from a background of equity trading, it's very much a one-way street when you're equity trading. Up is good, down is bad. Now, that has worked for lots of people for decades, but in the currency market, up, down, it really doesn't matter. The difference between being long or short a currency pair is simply the difference between buying or selling that pair. You're not blocked by any margin requirements, SEC requirements, Reg T requirements, brokerage in-house requirements, uptick rules, any of those sort of things that can prevent you from profiting in a down market with a short stock sale. You can get around that. You don't have to worry about that because up or down, you open up the entire gamut, the entire playing field of profit, as opposed to with an equity, most, if not all traders, particularly retail traders, are owners of stock, so that up is good, down is bad. Better risk management tools and more accurate analytics. This tonight brought to you by FXCM, and going to FXCM, opening up an account with them, the analytics that are available on their website, on their MetaTrader 4 platform, are phenomenal. And one of the advantages of FX is because the market only closes once. It opens on Sunday night Eastern time, U.S. About 8 o'clock or so, closes about 4 o'clock or so Eastern time on Friday. That the data points are all continuous. One of the challenges you have when charting, in particular a stock, is that the open and the close and the gaps can lead to a little bit of difficulty sometimes handling the data. Well, we don't have that problem because there's only one. The week begins, the week ends, and it's continuous trading for 24 hours a day in between. And the tools that are available now for free for opening up an account with FXCM are really, when I traded 20 some years ago, those tools were only available for the Goldman Sachs of the world. We used to get on the floor at the Forex, we had a trade station, and this is so long ago in the infancy of the internet that the only way we could get data was overnight. We had to leave our machines on and there would be a data pull overnight, and it wasn't even real-time data. So now you can get at the click of a mouse intense and accurate data available to you simply by opening up an account at a brokerage house. Immune to market manipulations and falsified data. Now, the conspiracy theorists out there will scoff and say, Greg, you don't believe that, do you? Well, my point is that it's a lot more difficult for, let's say, an entire country's government to set up and falsify data than in comparison to an individual stock in the U.S. So you are less likely to be the victim of those sort of insider trading market manipulations. Much more of a true free market, and the simple size of the market helps to make sure that everyone's trading on a level playing field. 50-to-1 margin and no commissions or fees. If you go to FXCM, you open up an account, you can have a 50-to-1 margin on the money in your account. Most brokerage firms will offer you the option of trading with a no commission based system. Now, what's that mean? That means your bid offer spread that we're going to talk about in a little bit is going to be a little wider. I mean, the broker's got to get paid somehow. But the 50-to-1 margin, there are brokers out there will let you get a little leveraged a little more. Leverage is a great thing, but it can be a dangerous thing. I'm much more of a realist and a conservative trader when it comes to that. And I think that being 50-to-1 is probably plenty of margin. What does 50-to-1 mean to you? Well, it means that when, for example, the standard contracts in the foreign currency market are 100,000 of the counter currency, 100,000, 10,000, or 1,000. It's a standard lot, a mini lot, or a micro lot. On a standard lot, on a mini lot, say 10,000 units, and let's say that the pound dollar, it's not trading at $1.50, but let's say it was. That would mean that you would need 15,000 US dollars to control to control 10,000 British pounds. Well, 15,000 divided by 50 is $300. So you would need $300 in margin in your account to be able to control that standard, that mini lot. So that's what I'm saying, that the margin required is 50 times the cash outlay. Just a quick example, every currency is different. Because you have to, particularly if you're not dealing in dollars, you have to convert back to, if that's your home currency, you have to dial back to dollars in order to do it. But it allows you to reach out and get beyond what you can do. Now, it doesn't mean that you should leverage yourself to the hilt and push all your chips to the middle of the table and take as much risk as possible. That is not what we're talking about. But there is an advantage to be able to allow you to put your money to work with a little bit of leverage. A lot of people come to me, with problems trading equities, and the idea is, geez, there are just too many to trade. Well, with 5,000 U.S. equities, the question becomes a lot of times, hey, Greg, where do you start? Where do I find something that I can do? Well, when you're trading currency pairs, there are only 6 major U.S. dollar currency pairs and about 18 major world pairs. You can focus on just a few currency pairs and still have plenty of opportunity. Now let's go back to that. You've got, I've seen, and I'm sure all of you have done it, you probably have stocks that you trade that you're familiar with, that you're used to, that you're comfortable with. Well, the ability to focus on 6 or 8 major pairs allows you to get very comfortable with the movement of the underlying pair that you're trading. I watch the dollar yen a lot, and I kind of watch the pound dollar, and the euro and the pound are kind of 3 of the ones that I look at the most. And you get very used to kind of what they do. As a floor trader back at the Forex, I stood for hours every day staring at the price tick in stocks like JP Morgan or Dell or whatever I would have been trading back then, and you get used to the movement. You sometimes can train yourself to sort of see things. And people ask me sometimes, I'll look at a certain chart or a trading opportunity, and sometimes some people say, well, what do you mean? Why do you see that? And there are times I don't know why I see it, what I see it. It's just those hours and hours, the hundreds of hours, the thousands of hours I've spent staring at trades and staring at prices. You start to develop this kind of, I don't want to call it a sixth sense, but you get a feel for what's going on. And the ability to concentrate on 6 major pairs, 18 in total, really allows you to focus, get up that learning curve pretty quickly, and start becoming a profitable trader. One of the other great reasons, trade when you want to trade. Morning, afternoon, or late night. Wherever you're joining us from tonight around the world, you can trade currency pairs. Because the market's open 24 hours a day, 6 days a week, it doesn't matter where you are in the world. The market's never closed for you, and you can find pairs that trade actively, whether you are trading in the morning in London or late night in Los Angeles or anywhere in between. Trade where you want. The technological advances that have come over, say, the last 10 years allow deep and accurate markets to be just a mouse click away. With the ability to trade with a smartphone, with a tablet, with a desktop, with a laptop, you're no longer tied to your desk. Years ago, if you wanted to be an FX trader, there was only really one way to do it. You had to go probably sit in a room with a bunch of other traders and be hooked up to a T1 line and be able to find, a shop that would allow you to trade. But now, trading is as simple as opening up an FXCM account, and I use it a lot for, and we'll talk about this in a little bit, but you may enter a trade while you're sitting at your desktop, but then you've got to go to work, or you have to live your life or move on with your day. But your smartphone or your tablet keeps you in touch with the market, and using a couple of tricks of order entry, you can make sure that you're always protected, but always in the market. And you can trade how you want. You've got extensive trading chart packages, news services available to you. The internet has brought all this information right to your desktop, right to your desk, put it right at your fingertips. And that's the beauty of trading with the currency market, is you're not tied to, for example, 9:30 to 4 o'clock Eastern U.S. time, because if you're somewhere on the other side of the world, this might be a very, very inconvenient time for you to trade U.S. equities. Not so with the currency market. You can trade when you want, where you want, and use the skills that you've developed as an equity trader to trade how you want. All these positives make it very clear that there's no need to quit your job, at least not yet. As we're familiarizing ourselves, let's go over the major currency pairs, give you an idea of what sort of symbols we're looking at. The U.S. dollar, you can see how they've built these, the first letter of the country, and then the currency, what it's called. The euro for the Eurozone members, the yen, the Japanese yen, the British pound, GBP, CHF. I did not take Latin, and I am not going to try to pronounce that because with my voice as bad as it is, it will sound even worse as let's just be sure that the Swissy is CHF. The Canadian, the Aussie, the New Zealand, all those are the symbols of the major currency pairs that are traded. Now, what is the Forex market? What is this currency market? What's this FX market we've been talking about? It's made up by pairing one country's currency against another country. As simple as that. We take the euro and the US dollar, we bring it together, we have a currency pair. It's the euro US. And if you look at the major pairs, this is where most of the activity happens in the currency market. The euro US, the dollar yen, the pound dollar, the US Swissy, the US Canadian, the Aussie US, pardon me, and the New Zealand US dollar. And you can see their nicknames over there, the fiber, that because the fiber, the dollar yen, the cable, the dollar Swissy, dollar loonie, Aussie dollar, and the Kiwi dollar. Now, as you notice, every one of these pairs had something in common. And here's what it was. As I poorly highlight, every single one of these pairs, in one way, is either the base or the currency is the US dollar. Let me go to got the wrong pen up. Now, cross pairs are the pairs that are not paired with the US dollar. So if you had the euro US and the US yen, what does that give you? That gives you the euro yen pair. So it's one of the things you need to understand is that when you take the dollar out of the trade, you end up with what's called one of the crosses. Now, I also want to point out here that if you were trading, and let's say you were, if instead of trading the euro yen down here, let's say you were long the euro US dollar and you were short the dollar yen in your position, in your account. Again, you didn't do this trade. You had two individual trades on. Well, the danger in a trade like this is that you are now doubly exposed to the dollar, because if you bought the euro in this case, you sold the dollar. If you sold this pair, you sold the dollar and bought the yen. So you would be doubly short the dollar. And it's one of the things you have to be careful of when trading currencies, whether crosses or not, that you look at the risk in your position, because it's very common to have more than one trade on at one time, and you want to make sure you're not doubling down unintentionally on one side of a currency trade or another. This might be a great bet if the dollar gets the dollar goes down and the other currency pairs accelerate, but an easier way would be to just simply trade the euro yen, not put double the money at risk on your trade, trying to make sure that you understand the risk in your trading. Now, here are the major crosses. Euro yen, which trades a lot, the pound yen, the Aussie yen, the euro Aussie, the euro Swissy, the pound Swissy, the euro pound, which is one of the ones that I look at a decent amount, and the euro Canadian. Apologize for the pauses, guys. The cough's getting bad. To reiterate, a currency pair is made up of the combination of two currencies. What do we call a euro US? We call that, there are two pieces to it, and it is the base and the counter. So the euro is the base and the dollar is the counter in this trade. Regardless of what the pair is, you always have a base and you always have a counter. First currency is base, second currency is current, second currency is listed is called the counter. When you're buying a currency pair, you submit a buy order. You buy the base currency, you always do, and you sell the counter currency. You always sell the counter. So your transaction is based off of the base. You do the opposite to the counter in order to complete the trade. Now, people sometimes get confused about this. I've used this example before. I will use it again. You probably use currency pairs already. You do, and you don't really understand it. Let's say that where you live, gasoline is, wow, that's really poorly drawn. I'm going to try that again. Give me a pen instead and see how this works. Gas is $4 a gallon. Well, in that case, we know that the base is 1 gallon of gasoline and the counter, I'm sorry, I apologize, it's the other way. It's 1 gallon is the counter and the base is the U.S. currency. So you're exchanging 4 U.S. dollars to get 1 gallon of gasoline. It's the same idea. It's just that we all use dollars in the U.S. all the time, so we don't really think about it that way. But it's the same idea. You're buying the base. In this case, you're buying the gasoline, and you're selling the U.S. dollar currency against it. When you sell a currency pair, and it's as simple as hitting the sell, you sell the base, and you buy the counter. It's the opposite trade. You do have to be careful. Some of the currency pairs that we've listed, depending on the broker that you use, you may see them listed. Some of them trade both ways. And what do I mean by that? In some cases, you could have Euro US. You could have a dollar Euro pair. That's not going to trade that much because this is the normal configuration. And it's just that what's developed over time based off of the U.S. dollar. There is an opposite currency pair, and it has a mathematically inverse relationship. So the value of the Euro US, if you looked at the value of the US versus the Euro, it would be the inverse, or 1 over the Euro US price. So if you took this price, inverted it, and that would give you the price of the opposite pair. Here we are with the quotes, and again, we're always going to have two-sided quotes. The bid is the price where the market maker will buy, where your broker will buy. The ask or the offer is the price where the market maker will sell. In general, retail traders sell on the bid and buy on the offer. I normally recommend, particularly when entering a trade, to use market orders rather than limit orders, and we'll talk about the kinds of orders, in order to make sure you get in. If you're trying to get in on a trade, you want to be a buyer, not a bidder, a seller, not an offerer, because you may not get your trade filled. If you look at the FXCM trading station, the quote here, Euro US, an older quote, 130.52 bid at 55. And here's what they would look like on the MetaTrader, an old screenshot, but yeah, because the pound dollar is trading around 163 right now. Look how you can tell how old the screen is. So the dollar yen is now trading at 108. Wish we had bought a little back then. I'd take out that offer at 81.51. Spoke about it a little bit ago. The advantage you've got in trading FX is obviously the market that's deep and liquid wherever you are at any time you want to trade. Using the correct order types combined with technology makes sure that you don't have to spend your life attached to your desktop in order to trade. And I'm going to show you some of the orders that you'll use when placing. You'll be familiar with these if you're an equity trader, but we're going to go over them. This is our friends at FXCM. Very easy, simple order entry system to right-click away off of their screens, and you can buy or sell and add stop losses or take profit levels, and we'll talk about those in a minute. But this is the screenshot of what you're looking at, and you can put in the volume, the volume you want to trade, the symbol you want to trade. You look at it here. I mean, you can put the volume. Here's your price. What kind of an order do you want? Do we want to make any modifications? Very, very easy to trade with. Very, very simple, particularly since you can use a lot of the trading right off of their screens. And here's an order entry. The red is the profit target, and the other red, I'll show you here. This red line is the profit target on this chart. This red line is our stop loss, and here was our order entry. Now, using FXCM, to simply change, all you need to do right here, just drag and modify, grab it with your mouse, drag the line down to where you want it to be, let go, boom, your stop loss order has been changed. You want to modify your take profit order, click your mouse, drag the line where you want it on the chart, and drop it in. And as a trader, as a guy who likes to use charts, I like to visually I like the visual nature of this FXCM platform because I can fine-tune it based on whatever chart I may be looking at. Sorry. I can enter a trade on, a 15-minute maybe, and then on the 1-hour chart find the levels at which I feel I can put my stops in and my take profits based on what I'm seeing in the market. Very easy, right in front of me, simple to do. Here again, you want to modify a trade, just grab it and move it. Easy, easy. Plus you highlight it, tells you exactly how much you would lose in pips and dollars based on the open order that you have. We talked about order types, and this is the order type that I believe you should all be using trading FX to make sure that you are protected from any of the quick movements that can happen, particularly around times when there is news out in the FX market. I'm gonna go on pause for 1 second, take a drink of water here to give me a little bit of a break. Thanks. An OCO, or one cancels the other order, it's a combination order of a stop and a limit order. What does it do? It ensures that only one trade will be executed, the other will cancel. So it's a perfect way to manage active spot trading. Now, what does this mean? If I put a buy in, let's just say right now the dollar yen, let's just say it's trading at 109, trading a little below there, but let's just say it's trading at 109. And let's say my stop, I want to, if I was going to sell it, let's just say I was going to buy it. If I was going to buy it, let's say my stop loss was going to be 108.75. My profit target was going to be 109.50. I could put that order in as I could either enter the order with a buy with an OCO around it, or I could enter my initial trade and then put in right after it executes an OCO. An OCO order. And what that OCO order will do is will make sure that only one of my trades gets executed. Because if I buy it at 109, I either want to sell it at 109.50 or I want to sell it at 108.75. What I don't want to do is I don't want to have it go down to 108.75, execute my stop order, have my limit of 109 not get taken off the book. The market guns, My order's still sitting there, and I now sell it into a rally at 109.50. I now have a short position, and I got all kinds of trouble if this thing keeps going up. Some serious losses available to me. So this is what I always use. I always use OCO orders when I'm trading. And you can see here, you can modify your orders, in particular your stop orders, by using something called a trailing stop. The stop I talked about earlier was a static number. I gave you that example of 108.75 as my stop limit. But let's say the underlying moved up. It traded up to 109.25. Well, I'm 25 pips in the money. I don't want to give back some of that profit. How can I manage the trade, particularly if I can't sit and watch it? Well, if I change my order, my stop, and I modify it from just a simple stop limit to a trailing stop, I can pick the distance between the current price of the underlying, 109.25 in our example. Let me see if I can get the marker and show you. And I could tell it that I want to have a stop loss that is 25 pips below wherever it's trading right now. So in our example, the underlying moves up to 109.25, and we put in a 25 pip trailing stop. So our stop is now at 109. If the underlying, as the underlying goes up, our stop goes up locked in step with it. Let's say, for example, that, let me clear these. Let's say it goes up and it goes up to 109.40. Well, our stop is now 109. Sure, you can all guess what it is. It's 15. And let's say once we get to 109.40, nothing, it doesn't trade up to 109.50, which is our limit, and then it trades all the way back down to 109.15. Well, that's not going to move. It takes the highest move while it was active, 25 pips below. We would be out of this trade at 109.15. So we would have locked in a 15 pip profit. We never got to our target. We didn't get our max profit, but if we weren't watching the trade, it would allow us to move up and hopefully follow a winner running up, but not expose ourselves to going all the way back to our original stop, which was 108.75, costing us 25 pips. So we would have saved, in our example, we would have saved 40 pips by using this trailing stop in that way, rather than leaving our stop at simply 108.75, the static stop. So trailing stop, a really good tool to use, particularly if you're not around. Let's talk about making money trading FX in 90 minutes a day. I'm hoping that all of you have joined us tonight have 90 minutes in your day. That's what we're looking for. Now, and I don't necessarily mean that, so you know, some of that might mean you sitting in front of your screen at your home for 90 minutes a day and trading. Some of it might be, 80 minutes, 60 minutes of prep work in front of your screen for 20 minutes and then watching your trades for the rest of the day. And that's what we're going to talk about right now. And what I'm going to show you is there are a lot of people out there who would look at a chart like this, a 4-hour chart, and say, wow, there's nothing going on. I couldn't have made any money today. There's no trading going on in the U.S. Canadian. Well, now we dial into the 1-hour chart and we say, well, wait a second. There's a little bit of movement in here. There was some opportunity to buy and sell and maybe buy some more. Let's dig a little deeper. Well, wow, on a 5-minute chart, and this is the same price, the same area, same chart. 5-minute chart, for example, we traded as low as 109.60 in this little move here, and 109.97 in that move up. Now, I want to be very clear. I'm not telling you that if I were trading this chart, I would have bought this low and sold this high. There are lots of people out there who will tell you things like that, and they are lying to you. But what I am telling you is that within this movement of 37 pips, there was some money to be made. And then if you look, we trade back down almost to the same level again, another 35 pips down. And then we trade up another, call it 30 pips. And these are 5-minute bars. So you're looking at a period of about, I don't know, 2.5 hours. So up and down and up again. It looks a little unchanged, but there was money to be made in there. And that's what you're going to look for. If you dial in even more, look at these 1-hour charts, the exact same period. Look at the opportunities, the up and the downs. And again, you don't have to worry about necessarily big, giant 100 pips moves. There's money to be made when you look below the surface. Look at the move. And again, that whole chart, I had to put it onto 2 charts because it was so big on a 1 minute to capture that same movement. And here again, you've got the dollar Canadian. Now I've put a 5-minute Fibonacci, a little tough to see. Let me show you if I can put the highlighter on it here. There's the one Fibonacci line, there's the other, there's the third. And then here's our baseline. So if we look at, I'm sorry, I lost my drawings. So let me do that again. Here's our Fibonacci's. And I'm not telling you that I actively trade 5-minute charts with Fibonacci's, but what I am pointing out is the same patterns that develop on daily charts and 4-hour charts can develop on Fibonacci charts. And they are, if you look here, we came off this bottom, traded up to just about right between the two here. We came back down, sat on this number for a little bit. We broached it, came back up, stopped right here, came back down, traded up to here, and then lingered. We did get up to this level here, and then lingered. So it was a Fibonacci movement on a 5-hour chart. As I said, I'm not telling you I make a living or anyone makes a living trading Fibonacci 5 minutes, but it is one of the things you'll hear and see. What I'm trying to point out is that you can apply the same trading strategies that you use for equities, for options, for futures. You're used to, daily charts and maybe longer term strategies, but you now just focus on the 5-minute, the shorter time frames. And when I say shorter time frames, what I mean is 4-hour, 1-hour, 15-minute, using them all in conjunction. I just don't look at one chart. But you also want to actively manage these positions with tight stops and take quick profits when available, using those OCO and trailing stops. The point really is that pips are pips. Yes, you could go out and make 100 pips on a 2-day trade, but it's the same amount of money in your account as making 10 pips 10 times in 2 days. We have one of the guys back at CTU, and beginning of the year we were talking more about longer term trading, putting a trade on for a few hours to a day to a couple of days. Some might call it swing trading. And I told Rich, I said, hey, we're going to be talking more about the shorter term trading where you can kind of get in and get out, get in and get out, get in and get out. And he's like, oh man, thank goodness. He said, because I couldn't sit there. I got to click the mouse. I couldn't sit there and just stare at the screen all day long. So you have to figure out, and here's what I'm saying. You want to build your confidence using an FXCM demo account and improve your eye for the pair you're trading. Develop the skills and find out if you're somebody who can't stomach the 5-minute, 1-minute charts and you need a little bit more sanity, then move yourself up to being more of a swing trader. But the best way to figure that out is by using a demo account with FXCM. Make sure you practice. You may find out that you're a swing trader. You might find out that you're a 1-minute, 5-minute chart person, and that's how you want to trade. But I don't want you trying to figure that out with your money on the line, because what I'm going to tell you is that You trade differently when it's your money, and I don't care how little the money is, than in a demo account. But you have to try with your demo account to replicate as best you can, make decisions as if it were a regular trade. So that's what I want to talk about. I want to make sure you understand that using your demo account will help you build your confidence, improve your eye, and find opportunities to trade. I want to show you a trade that sets up at the end of the week. Occasionally can be a nice short-term trade. I like to call it the weekly closeout reversal. And where you'll find it is you want to look for actively traded pair that has made a strong move over the past week. This move can be up or down. And what you have to realize is that traders who've made money will naturally look to take profits as the market moves towards the close. It's the same sort of thing that you'll see trading equities at the end of a trading day. If a stock has made a strong move one way or the other, a lot of times in the last hour or so, 2 hours of trading, you will see profit taking come in. I mean, how many times have you listened to CNBC and they've talked about the market itself reversing and some profit taking caused the rally to fizzle, or profit taking stemmed the downward move. So it happens regularly, and the trade should set up in the morning of the New York trading session on Fridays. And what you're looking for again is a strong move. Here's an example. If you'll notice, we had, because I'm highlighting with a yellow highlighter with a yellow background, sorry. We had this move up, and then this down bar was the Friday reversal. We had 1, 2, 3, 4, 5, 6 up days the Friday before and the entire week. So now we had the opportunity for our setup. Now if you look at it on the 4-hour, and this is the morning, this is 4 hours. So over the last day, it sort of ran out of steam. Apologize for the coughing, guys. It ran out of steam and made this move to the downside. And if we go one more day, you can see it on a 1 hour. And these were the last few hours of the trading day. And this trade, to me, once we broke this level, this was a sell, and the move down was about 60 or 70 pips. This is not a life-changing trade, but hey, you can make 20 or 30 pips or 40 pips on a trade as you're looking for setups. This is a trade that can pay dividends for you. Let me erase the drawings. Here it is on a 15-minute, even showing more dramatically after this bar here. You saw just a complete lookout below. Once you took out from a kind of a trader technical, let me just highlight it here. Once we took out this pivot low, to me, that's a sell. And then you even got it again. You put in another pivot low. It traded back up, but came back down and took out that one again, gave you another opportunity to sell it if you missed the first one with that signal of the takeout of the pivot low. Something you would learn about, we talk about FX and FX in our phase 1, phase 2, and phase 3. You can learn about those kind of technical analysis pieces that will help you make those kind of decisions. And here it is on a 5-minute, just again extending. And if you look at it from that technical standpoint, highlighting it again, you had lower low, we took it out here, another lower low, we took it out right here, lower low, lower low, lower low, lower low. When you're seeing lower low, and even we had a high here, then you have a lower high, a lower high. By this point the trade's pretty much over, but a lower high. When you're seeing lower highs and lower lows. That's a trend going your way, and this trade can set up, on Fridays. And there's a lot of pairs to look at. You may even see one this week. The yen has been trading up pretty strong, and that could be one that may set up for you at the end of the week. And here it is in a 1 minute. Just another quick look at it. Now this is another version. This is another chart. Same sort of thing happened. We got the same movement up. This was another day, and it happened to be the yen again. We put in a pivot high. We rolled over on the Friday. There's the rollover again on the 1 hour chart. And then this is a longer version of the 1 hour chart, but we sold off considerably after a strong move. This trade benefits from the natural ebb and flow of all trading markets. Similar, as I said earlier, similar to the price reversal you'd be familiar with from the close of trading each day. This trade can use tight stops and should be actively managed. So it's one you really want to look at. I'm going to end tonight, guys, with a trading secret that nobody ever talks about. You've probably never heard anyone tell you this. Take a loss. That's what I'm talking about. And I know you're now saying, well, what the heck is this guy talking about? Take a loss. And why am I telling you this? Because everybody takes losses. There isn't a trader out there. If you find somebody who tells you that they don't take losses or that their system, never loses, they're just lying to you. And what I find is that when you enter a trade, when I look at a trade, I always look at, okay, where's my downside? Where can I get out? What's my worst case scenario? And then I try to figure out, okay, where can I make profit on this trade? And based on those two things, is it a trade I want to enter? But what I find is that as difficult as it can be, taking a loss a lot of times is the right thing to do. And why it's the right thing to do is, even if you decide, let's say you're trading a currency pair and you get stopped out, instead of moving your stop away and staying in the trade, hoping upon hope that it's going to turn around because you know it's going to turn around, I want you to take the loss, get stopped out, and then I want you to look at it with a bit of a fresher eye. You're no longer tied to that position, and I really believe you can make a better decision without a position on. If you want to re-enter the position that you had, I don't always recommend it, but if you take the trade off, take a loss, figure out what you learned, try to decide now that you have more information, what do you want to do? Don't be tied to the old trade. Take the loss, close the book. I used to have a general rule that if I would dream about positions, my options positions, it was usually time to dial them down. And I had a few of those over the years where you'd be, when I say dreaming, I mean literally I would be in bed at night dreaming about the position and the stock and certain strikes and positions and things. So it can affect you, and it's difficult to make decisions under the pressure of money on the table. But taking a loss, although never fun, hopefully a learning experience, will also allow you to make better decisions. I mean, there's a screenshot of our paper trading account. You got to take a loss. And then, got back in and made some money on the trade overall. But you have to be willing to take a loss. It's crazy to think that. People always say to me, Greg, you shouldn't tell people to take losses. It's part of life. It's part of life as a trader. You have to be able to take losses. And that's what Guys, I apologize for the long pause. It is really hard to take a trading loss, but it's a great educational opportunity. It helps you think more clearly. It helps you be a better trader. And again, although it's not we never want to take losses. Everybody has, as I've said before, I've taken more losses than everybody in this trade combined. So you can learn from them, and you can become a better trader by getting out of a bad trade and starting over again. Please take a moment to reach out to our educational advisors at 877-70-CYBER. They can talk to you the benefits of our cyber trading group. And if you have any questions for me, Greg M. at CTU Trading, 877-70-CYBER, or you can call the office at 516-280-5350. This is Greg McDermott for Cyber Trading University signing off. Everybody have a great evening.